Welcome to the 2021 Economic Forecast Zoom event, hosted by your Birmingham Bloomfield Chamber. I think I know everybody on this call, but if I don't, my name is Joe Bauman. I'm the president of the Birmingham Bloomfield Chamber. I want to thank you for attending this morning and supporting our forecast series, today being the first of three forecasts that we will be doing throughout the course of the year. God willing, this will be the only one that we do virtually, but we'll just have to wait and see. I do want to introduce and acknowledge the rest of the team. Cheryl Geralds is our operations manager, and hopefully she helped facilitate all of your registrations this morning. And Kelly Bennett, who is our marketing and events manager. And Kelly's really the one pulling the strings behind the curtain this morning. So thank you to both Cheryl and Kelly. I hope everybody is aware, but if not, we did lose Samantha Michalak as our membership engagement manager back in September. That was Sam's decision, not the Chamber's. We were sorry to see her go, but we have plans to be replacing Sam in the first quarter of 2021, and we will be back up to our full small but mighty staff. So as you all know, we could not run the Chamber the way we do without our dedicated volunteers, primarily being our ambassadors and our board of directors. We have many board members and ambassadors on the call this morning. Thank you all very much for all you do. I think we have more people, at least that will appear on my full screen, but if I could ask if you're on the board of directors or if you're one of our Chamber ambassadors, to just give a wave and be acknowledged. Thank you. I'd also like to take the time to thank our sponsors for this morning's program. Please keep in mind that because of the outstanding support we get from our sponsors, we're able to put together programs like these and others throughout the year at either no cost or low cost. I probably don't have to tell you the critical role that our sponsors have played since March, especially given what's happened with the pandemic and the various shutdowns, lockdowns, and restrictions. With losing the ability to hold events in person has been financially difficult, obviously, for the Chamber. And if not for our wonderful sponsors who have stood with us every step of the way, we would not have been able to continue to perform and to act the way we have since March. So I want to acknowledge the sponsors for this morning's program. Our diamond sponsor is the Clark Hill Law Firm. Jason, thank you so much. Our platinum sponsor is Bank of Ann Arbor, Pam and Dan, and I don't know if Steve's on the call, but there you are. Good morning, Steve. Thank you so much. Our gold sponsors are Fenner, Mellstrom and Dooling, CPA firm, and Mercantile Bank. Todd, thank you so much for Mercantile Bank. And our silver sponsors are the Birmingham Shopping District and the Birmingham Bloomfield Credit Union. Richard and Jerry and Linda, thank you all so much. I also want to acknowledge especially our legacy sponsors for 2021. These member businesses agree to invest a certain amount in the Chamber on an annual basis to support all of the programming and professional development we do. So many of our smaller Chamber businesses who may not have the means to do some, attend some of our events or take part in programming, again, we're able to offer those programs at either no cost or low cost because of the generous contributions of our legacy sponsors. And our legacy sponsors so far this year include Clark Hill, Bank of Ann Arbor, Birmingham Bloomfield Credit Union, North America Midway Entertainment, and Chief Financial Credit Union. I think I saw Tom on the call. Tom, good morning. Thank you so much. We really couldn't continue to function as a Chamber without our legacy sponsors. And so if you're ever in the need of banking or legal services or accounting, please consider using one of those businesses that support the community by supporting the Chamber. Okay, our moderator this morning is Jason Canvasser from Clark Hill, as I mentioned before. Jason is a member in Clark Hill's Detroit office, where he practices in the litigation practice group. Jason's practice focuses on advising clients on best practices for managing and avoiding potential risks and liabilities that include complex commercial, contractual, and business disputes, defensive premise liability and auto negligence claims, real estate related matters, and issues relating bankruptcy and creditors' rights. As part of his practice, Jason frequently represents clients on numerous issues relating to the sale, distribution, and manufacturing of alcohol and cannabis products. Jason received his BA from U of M and his JD from Wayne State University Law School, where he was a member of the Law Review. He currently resides in Birmingham with his wife and 3 children. And in addition to serving on the Chamber Board of Directors, he also sits on the Birmingham Board of Zoning Appeals. As I mentioned, following the presentations, we will field some questions. Please use the chat room to put your questions in there, and then Jason will field them out to our speakers. So without further ado, I'd like to turn this morning's program over to Jason Canvasser, who's going to introduce our first speaker. Take it away, Jason.
Thanks, Joe. Good morning. Good morning, everybody. It's my pleasure to introduce today's first speaker, Paul Traub. Paul currently holds the position of Senior Business Economist at the Detroit branch of the Federal Reserve Bank of Chicago, where his responsibilities include both research and current analysis. Prior to joining the Economic Research Department of the Chicago Fed, Paul was the president of Scenario Economics and senior economist for America's Commercial Transportation Research Company. Mr. Traub retired in 2008 from the position of corporate economist with 25 years of service at Chrysler. At this time, it's my pleasure to welcome Paul and turn the program over to him.
All right, thank you very much, Jason. It was it's always nice to hear about myself, first thing in the morning. At least I know I'm still alive. So I want to share my screen here as quickly as possible, and I can get started. I have to start by giving my disclaimer, of course. I may make some comments, especially during these tumultuous times. They may be my views and not necessarily the views of the FOMC or the Federal Reserve Bank or Charlie Evans, the president of my bank. So that's my disclaimer. So now I'm free to go. I'm going to talk about the economy, of course, U.S. economy, C plus I plus G type stuff. And then I want to spend a little time on the auto industry because I think that's so important to the state. And then we'll finish up with some, the perspective from monetary policy, inflation, and labor markets. I've got 20 minutes, so I'm going to set my stopwatch so that I can be on time, and we'll keep moving. First slide here basically shows the GDP change that we've experienced from the pandemic. It's been quite the fall. Fell 31.4% in the second quarter, and then bounced back. Everyone talked about this V-shaped kind of recovery. We'll get into that a little bit more detail. We start talking about employment. It's really kind of a K-shaped recovery. Is that it's very bifurcated. For some are doing quite well, like myself. I now haven't missed a paycheck. I keep working, and I have fewer expenses. So some people are doing better. Others have lost their jobs. According to the forecast, and I'm using the blue chip, I'll give you the expectations from the Fed later. If you follow the blue chip forecast, you'll see that they have the index, a little box on the right-hand side shows at what point you would get back to 100%. That's when you would be back to previous output, as the fourth quarter of 2020 would be sometime in 2021. Right now, the expectations are third quarter, but that all depends on what happens with the pandemic. When we look at the recovery of the economy, consumption has been everything about it. I mean, the consumer has been consuming. This reminds me of the 2000 recession where we never lost a tick in consumption. And consumer sentiment, although it fell, didn't fall like it did in the Great Recession with the financial crisis. It's bounced back a little bit. It's not great, but it's not horrible. So the consumer, on average, according to the University of Michigan, is not doing that bad. And you can tell by the retail sale jump back. We saw a large decline in retail sales as businesses shut down and people were unable to go out to eat and those types of things. But you can see that it bounced back very quickly. Um, the most recent month fell slightly on a month-over-month basis, but you can look at the level of retail sales is above where we were coming into the pandemic. A lot of the purchases and services have been curtailed are goods, so goods purchases are doing quite well. Um, Real disposable income. This big spike in disposable income, of course, is the stimulus money that was sent out. So a lot of people got checks, and people that were working got checks. I got a check for my son, and so we spent it. So that really helped the retail sales, and of course, that's what stimulus is supposed to be all about. Um, the amount of money, this is now on an annualized basis. You can see in the second quarter annualized basis. If you go across the different types of categories, I won't cover them all, but you can see in an annualized basis over 3.3, almost $3.4 trillion annualized in relief money sent out into the economy. So a 20 million a billion a $1 trillion economy, you can see that's a big chunk of it. So it's a sixth of the economy coming out in a very short period of time, which helped the economy. A second package has been passed, $900 billion package again, $600 to individuals, depending on their income, enhanced federal jobless, extensions of pandemic unemployment assistance. A lot of concern about the unemployment existence. The federal jobless is $300. A lot of businesses said that it was keeping people from coming back to work with $600, so they lowered that amount. And there's a bunch of other things to help colleges and schools and vaccine funding, childcare, a lot of the stuff that was called that was added to the bill and received a lot of complaints. The auto industry, of course, took a big hit in March, April, May, but it started back pretty quickly and jumped back to levels pretty consistent to last year. The year it was already starting to kind of slow down a little bit coming into this pandemic. So the numbers that we saw in seasonally adjusted rates were very consistent, but the year ended up finishing up about 14.5 million. Expectations were that it was going to be somewhere around 16.8. So that's a big change, but that was all lost in a certain period of time. One of the reasons why the auto industry did so well is the buyers. Again, I talk about the bifurcation and those that the kind of the haves and the have-nots. The average age of a new vehicle buyer is around 53 years old. They're usually fairly well off. They're probably in the essential worker category. Older people, 65 over, make up almost a third of all auto sales, and you can see that this is back in 2015 study, and this is consistent with what I used to believe when I was at the Chrysler. Is the income's anywhere between $80,000 and $100,000 now, average salary of a new car buyer. So they're not really hurt at all by what's going on in a lot of ways. You can see what's happened to pricing. So if you look at that little yellow line down at the bottom, that's overall CPI growing about 1.2%. But you look at used car prices in December are up 15.2. New car prices up 8.8, and that has to do with supply. As supply gets tighter, we've seen a decline in the amount of incentive spend, and that's been raising prices a lot faster than inflation. So while the break evens for the supplier community are pretty close, the auto companies should be doing pretty well with margins. This slide here, I just want to show what's been happening and where I think the auto industry will go. So if you look over the years, when I was young in the 70s and 80s, industry was growing on average, if you count trend, at about 135,000 units a year. Since 2000, we've seen the growth from peak to peak in 2000 to 2016 of about 6,250. So we're in this kind of flat. I think this is kind of where the industry resides now. And for a number of reasons, we could go forward and not see peaks reaching much above 17 million for a number of years going forward. One of the reasons is we're not growing households like we used to. So the growth rate in households has declined precipitously. And you can see that the number of people in each household has declined. So you don't need the kind of fleet that growth in fleet that we've had in past when households were growing and people were having lots of children, moving them around. Also, we're seeing a big decline in the number of licensed drivers. If you look at how many drivers were added to licensed drivers between 1951 and 84 was 93.2 million. 32 years later, we added just 72 million. So that's about 20 million left, fewer drivers being added. So people are driving. And my son's going to be 16, doesn't have his driver's license. A lot of his friends aren't getting them. It's just not that rush to get a driver's license, and we're not driving as far now. So a lot of these vehicles that were sold most recently are going to be in really good shape. You can see that in the last economic crisis, it took almost 7 years to get back to the vehicle miles traveled that we saw at the end of 2007, and we fell considerably more this time. So it could be a number of years before people are driving as far as they have prior to the Great Recession. On the private investment side, you can see non-residential investment fell pretty drastically. It did bounce back somewhat. It's up 22.9% in the third quarter, but you can see it's well below the previous peak. It was doing quite well prior to the recession. But when you look at manufacturing index, this is a kind of an indication of how purchasing managers feel business is going. You look at manufacturing, it's above 60. So anything above 50 means expansion. And the composite for November, the composite will come out later this week. You can see that it's above 50, also 56. So businesses are doing well according to purchasing managers as they're starting to bounce back from the recovery. Industrial production, though, when you start to look at the industrial production side, you can see that it's still way down below where it was coming into the pandemic. However, if you look at new orders for durable goods have been doing quite well. People have been buying cars and refrigerators and working on their house. But you can look at what's happened with motor vehicles and body parts. It's way back. The auto industry has bounced back quite strongly. On the gross private domestic investment side, you can see on non-residential structures, this is kind of a concern of a lot of individuals, is what's going to happen to the stock of buildings as people start to come back. There's a lot of office space and that type of commercial real estate that you can see that we're not seeing non-residential structures bounce back, and it actually had started to decline late in the fourth quarter of 2019. This barometer here kind of shows what's going on in the office world. Workers returning to office barometer. This is done by Castle Systems. They have this is using 10 large cities. They do security software. So if you go into a large building and you swipe your card, it shows up if you're there. You can see that people returning to work. You can see how bad it's fallen. And so there's a lot of empty office space in the city of Detroit. And the concern is what's going to happen at the end of this. Are people going to go back to the office? Are there going to be more people telecommuting? We've talked in our office about maybe having more flexible hours now that telecommuting is becoming ingrained into the system. So this is going to be a concern moving forward, I think. However, in the residential side, we've seen a completely different story. Residential investment fell, but bounced back very strongly in the third quarter. Housing starts and permits jumped way back up. You can see 1.5 million starts and permits. That's well above what a lot of analysts would think is what's needed. Somewhere about 1.2 million to replace stock. But a lot of people are reconsidering where they want to live, and there's been a lot of action in the housing side. Existing home sales have sprung back. You can see they're at levels consistent with 2005, prior to the financial crisis, which was driven in somewhat by home prices rising too quickly, and home prices are rising very quickly. You can see 10.2% on the FHA purchase only, 10.2%, 8.4% on the Case-Shiller national index. So home prices are rising as people are buying homes. They're mostly in the upscale. The problem is availability. Again, talking to realtors, there just isn't that inventory out there. If you have a good home in the right price range, it'll sell immediately, probably at or above asking price. One of the reasons is the Fed. We've done a lot to bring down mortgage rates with the activity we did, bringing down rates. You can see mortgage rates are quite low. I just refinanced my house. And I'm going to be refinancing another soon. Um, and and with these interest rates set, you can get a fixed rate interest under 3%. That's helping the market. However, one of the overhangs that's a concern, and with of course the last package did have some delaying of foreclosures. You can see that delinquencies are quite high. Foreclosures are curtailed, and that overhang remains to be seen how that's going to be addressed once things start to come back, as a lot of people who lost jobs are unable to make home payments. On the labor conditions side, you can see the unemployment rate shot way up for 1 month and then came back down. It's now in November was 6.7%. Friday we'll get the December labor numbers. However, the participation rate fell pretty good. So one of the reasons why the unemployment rate fell as quickly as it did is that a lot of people left the labor force. You can see the large decline in the labor force, and this could take quite a long time to get that to go back. So you change the equation. If you leave the labor force, you're no longer unemployed, so there's fewer unemployed people. So you change that dynamic, and that brings down the interest rate. When you break it down by race and gender, and this is the bifurcation that I talked about earlier, and what a lot of what has come out prior to the election about inequities. So you can see the Black population is a lot more highly unemployed. Hispanics are more highly unemployed than whites, and women have a lower unemployment rate. But that's because more women have left the labor force. There's still this idea that women stay home, take care of the children, right? Kids, and a lot of kids are taking school from home. So more women have left the labor force than men, and that's why their unemployment rate is lower. But you look at others, white men only down 2.2%. You look at African Americans down 2.9, Hispanics 1.8, Asians is actually up. So we had a lot of job losses. Some of them were temporary, and those are coming back. But permanent job losses are a real concern. 3.7 million permanent job losses. That started to improve a little bit in October, but it jumped back up again. These are the jobs that may not come back after the pandemic is all over immediately. So the unemployment claims continue right around 800,000. That's not a good number. Mostly in a good economy, maybe 250,000 would be a fairly good number. But you're starting to see that number we've kind of hit the wall with job creation. In November, we saw 245,000 jobs. You saw a lot of come back early in May and June, July, but that pace of return is quite slow. And you can see that we're still way below where we came into this pandemic with total non-farm employment. So a lot of people are still out of work, roughly 10 million people. Hourly wages shot way up, and that's because of the mix, but also because of the incentive monies that were sent out to the stimulus money. But a lot of it has to do with the mix. Who lost jobs? So you start to look about what companies and what areas or sectors are doing well. If you're in leisure and hospitality, you're not doing so well. They've lost 20 million jobs. You can see that over a third of all jobs lost are in this leisure and hospitality area, but they only pay $17 an hour average wage. So that changes the mix of wages, and that's one of the reasons why wages look to have jumped back so quickly. You can see an inflation side, we have no inflation, basically below 2% on either CPI or PCE. But we saw a big jump in food prices, and this is again one of these issues with food insecurity, long lines, people collecting food, and now housing insecurity, people unable to make their house payments. There's been a moratorium on that, on evictions, but if that goes off, you can see there's been a big jump in these issues. And that data is from a survey from the U.S. Census Bureau, by the way. Inflation expectations remain below 2%, so the Fed is still able to keep the hammer down. Our 25 basis points for the federal funds rate is quite low, and that's expected to last for quite some time. The yield curve has recovered. This is the one index that whenever it inverts, we do have a recession. It had inverted over about a year ago prior to the recession, and everyone said, well, on average, we have a recession within 14 months, and of course, we had a recession. It's not the inversion of the real curve. It's usually some kind of outside. Like they say, an expansion doesn't die of old age, it dies of some malady. And I think a pandemic is a very big malady. However, we've got the spread quite well, so lending is going on, and that yield curve is very supportive of expansionary policy, which you can see here. Fed's projections for economic growth. They're expecting that this 2020 will finish up down 2.4%. Then we'll see some strong growth coming back as we go back towards trends, longer run about 1.8%. Unemployment rate will get back to around the 4% range, but not till 2022. Get back down below 4% by 2023, with the long run expectation about 4.1%. Inflation, again, no expectation of any inflation out through 2023, either core or overall inflation. So the federal funds rate expectation at under 1%, 0.1%, 25 basis points or so, is solid out through 2023 based on the Fed's latest. It's all going to depend on what happens with the virus, and this is what's really we're in this surge after surge. People aren't staying home. They're not doing the social distancing, although the use of masks has risen. Talking to some people in the medical field and others that are doing surveys, people are starting to get the word, but still not enough. If you saw the news yesterday, a lot of people at the Capitol without masks, and you could see what's happening to the death rate. It's equivalent to a dozen or so jumbo jets falling from the sky every day. One of the things that bothers me is the way in which we've become callous to the fact people are dying. Somebody shot yesterday at the White House. That's just another death. I think what the impact this is going to have on society going forward is it's going to be tremendous as we try to reopen economies and get people back to work. But as these surges continue, this is going to have a big impact on these forecasts I showed you earlier. So in summary, economic activity suffered an unprecedented decline. Labor markets did respond quickly. We're still seeing around 800,000 unemployment claims a week. Federal Reserve, we've done extremely a lot measures to try to bring back the economy. There's been a lot of federal stimulus in this to try to do that. There's my phone ringing. Economic forecast estimates for the U.S. economy is that we could get back to where we were prior to the pandemic sometime in 2021. But this all depends on how well the vaccines work and how many people are willing to take the vaccine. A lot of surveys are many people don't want to take the roughly a third of the Americans don't feel it's safe. They've been told that not to take it. And that's going to be a big concern. That's going to be a big constraint until we get back to a herd immunity of somewhere between 70 and 80% of the population vaccinated. We're going to be a long time before we can get back to normal. I'm going to stop my sharing and you can move forward. I think we're taking questions at the end. So thank you very much. That's what I have. That's what I have, and that's my story, and I'm going to stick with it. Thank you very much.
Thank you so much, Paul. Jason, if you'd like to introduce our next speaker, please.
Thanks, Paul. We appreciate that. Our next speaker is Todd Whitmer, and it's my honor to introduce Todd. Todd is a senior vice president of Southeast Michigan is the senior vice president, Southeast Michigan president of Mercantile Bank. Mr. Whitmer focuses on growing Mercantile's commercial middle market business in Southeast Michigan. With over 30 years of banking and commercial finance experience with middle market companies, his focus centers on commercial C&I and real estate loans. Mr. Whitmer has held positions with national, regional, and specialty lending organizations throughout the Mid-Atlantic, Southeast, and Midwest regions of the country. And with that, I'll turn it over to you, Todd.
Thanks, Jason. My pleasure to be here this morning. It's always fun to follow up someone like Paul. I don't have any fancy slides or anything that is going to be probably as exciting as what we just heard. So thank you, Paul. For those of you who are less familiar with Mercantile, we're about a $4 billion bank here in Michigan. I discounted that down a little bit for the PPP loans because all of our balance sheets are a little bit inflated right now. As mentioned, I'm leading our efforts here in Southeast Michigan. And we see this as a tremendous growth area for the bank. We predominantly, over the last 23 years, have been solely focused on Michigan companies. We've recently slightly expanded into Northern Ohio and Northern Indiana. So more to come on that. I've been asked to share some data points, comments, and thoughts on the impact of community banking in Michigan, the role throughout the pandemic, and then what lies ahead. I will say I'm very proud to be part of the community banking sector. In my history, I've been with some of the larger banks, the trillionaires and larger regionals. And certainly through this pandemic and the current situation, very proud to be part of the community bank sector. If you look at what we did, 90% of banks in Michigan participated in the PPP loan program. 50% of those loans were from banks that held less than 25% of the deposit base in the state, which speaks volumes for what the smaller and community banks did. Mercantile and several of my industry colleagues that are on the call today are responsible for billions of dollars that closed here in Michigan of PPP loans through the third quarter of 2020. To put that in perspective with some numbers, Michigan generated approximately $16 billion in PPP loans, which puts us 9th nationwide. And that's distributed over 128,000 individual PPP loans. This was largely due to the community banks, as mentioned. 45% of those PPP loans were from lenders with assets under 10 billion. So think about that. That's a pretty impressive number. And approximately 60% of all small business loans, which includes PPP loans as well, were made by banks under 15 billion in asset size. And if you look at the loans that were made, 99% of all PPP loans were under $2 million. And if you look at just the simple math, that ties back to the number that I mentioned earlier here in Michigan. The average is about $125,000 was the average PPP loan. So, really focused on that small to mid-sized company. So as far as community banks, where do we sit? I think Paul mentioned this or touched on a little bit. Community banks are holding a record level of capital. We could not be in a better position. And I think that goes for the banking sector overall. Also, our asset quality remains very strong with very low non-performing assets. And I'll just share some numbers here for the category of $1 billion to $10 billion in asset size. Average tangible net common equity to tangible assets, which is a ratio that we look at how the strength of the capital of the bank, adjusted for PP loans, is still above 10%, so very strong. Average NPAs or non-performing assets is at an average of 0.86, so less than 1%. To keep that in context, during the Great Recession, that was somewhere in the high 5s to 6% on average. So a lot of room there. I'm not going to speak for particular banks, but ours is much lower than that. Just goes to show the asset quality that most of the banks have right now. And I'm certainly not making a comparison to what we're going through today with the Great Recession. As you could see with a lot of Paul's numbers, there's not a fair comparison. I was just trying to point out that banks are strong. We have a lot of capital and we're willing to lend. For the most part, our C&I and CRE, which is our investment real estate book, clients are doing pretty well. You can see it in some of those charts. After the second quarter, a lot of our companies on the manufacturing side really bounced back and had a very strong year. But I will tell you, the PPP loans were critical because it really kept them afloat and really got us through that tough spot. For the most part, again, our C&I book, it looks pretty good. And I think any of my colleagues on the phone from other lending institutions will probably say the same. And so far, our CRE real estate portfolio has held up strong as well. And there's some real bright spots in there. The industrial warehouse sector is in high demand right now. Obviously, there's pockets of stress. So all that sounds good. And somebody could say, well, Todd, that's great. The banks are doing well. Some people bounced out of this really well. But what does that do for small business, retailers, restaurant owners? That's the group that has, I'm stating the obvious that everybody knows, that's the group that's really been hurt here. And I think for all of us on the phone here, we'd love to see a much more targeted rifle approach to the individuals, the business, the owners that have really been impacted here, instead of a broad brush or shotgun approach. But that's certainly not my call. And I know I speak for the industry colleagues on the phone that we're here to do everything we can. We're here to support you. From a regulatory standpoint, we're doing everything that we can possibly do. So I thought I would share just some of the recent updates in case you missed them. Joe, I know you sent around something last evening that kind of gave an update, but I'll just highlight a couple of things here. There's been an adjustment to the first round of the PPP forgiveness. There's going to be a short form or simplified under the $150,000 loan amount. And if you recall, if you look at that simple average I mentioned a few minutes ago, the average loan was $125,000. So that'll capture a lot of those loans. It'll hopefully be very simple for folks to have their forgiveness done. The second round was announced, $248 billion plan. There were some things that came out yesterday. I know there was an internal call here at Merck just to talk about some of those. We think there's going to be more information coming out today. Pardon me. And that we'll be rolling that out, as well as other banks will be rolling that out by the end of the week, and I think go live potentially Monday. The fortunate thing is now we've all been through this once, so it's much more automated, and we're hoping that this will go very smooth. Who's going to qualify for that, how they qualify, how that ties into the first round, not 100% sure yet, but we're working through that, and all of us will be reaching out to customers here shortly. In addition, there's been an extension to the TDR, which is Troubled Debt Restructuring Rules, which is extended through January 1st of 2022, so basically a year from now, or 60 days past the official end of the pandemic. And if someone can tell me when that's going to be, I'd be thrilled. Like most of us could work. We're anxious for that. $25 billion in housing and rental assistance, which Paul touched on that in his presentation. And again, we're doing everything we can from a lending standpoint. We're here to help. I know, again, my industry colleagues that are not speaking this morning, I know we're out there and we're trying to do everything we can and that we're able to from a regulatory standpoint. So keep in touch with your lender and, you keep working with them and your relationship there. So what are challenges on the horizon as I sit here in January 21? Again, a new strain of COVID or, spikes that has everyone nervous. Certainly if it, we don't want to get back into, but hopefully we don't get back into the situation where we're closing plants again for 30, 60 days. That's a real risk, but people are trying to build in that cushion so that we can get through that in the event that happens again. The short-term risk for these longer extended lockdowns, again, I mentioned it, the retail stores, whether that's standalone strip malls or strip centers and malls, restaurants have been severely impacted, movie theaters, hotels, some of the very obvious. But when I think about, the Detroit market here, those are the businesses and the owners, and then obviously the employees that have been impacted significantly. The other thing that was touched on, we hear it over and over from a lot of our manufacturing customers. They're still having problems getting skilled workers to come back to work. So I'm hoping that with some of the adjustments in that additional unemployment, that will fix some of that, but that's going to be an ongoing problem here if we can't get folks to come back to work. And then the mid to long term, really to me is a big question mark, is the office space. Again, Paul touched on that. We saw some numbers there. So far, the absorption rate and the leases and things seem to be holding up here in Southeast Michigan, but the long term impact of that, we just don't know. So whether that's people keep the same amount of floor space or square footage, and they just have rotating people, or they don't have as many people in the office on a day-to-day basis. I think we will see a combination of in the office and a much more flexible work schedule for people working from home once or twice a week. I think that's where we'll head, but that's my opinion, nothing other than that. So before I turn it over and open it up for Q&A, I did want to share, and I know a lot of companies and people on the phone and their business that have done the same. But in December, I'm very proud that we as a bank, in addition to our normal donations, came up with an additional $100,000 statewide to donate towards food programs and housing. And here in Southeast Michigan, I moved some money around. And in addition to that, we delivered $20,000 in checks in the month of December here in Southeast Michigan. So I just wanted to share that. I know I speak for many folks on the phone that have done the same. And I thank everyone on the phone that has done that. And I just wanted to share it because we're proud of doing so. So with that, I will I'll turn it back over and we can open up Q&A for myself, Paul, or I'm sure most will be for Paul, but that's okay. Thank you
so much, Todd. So again, if you do have a question for either Todd or Paul, feel free to put it in the chat area and Jason will grab those questions and ask them. But before I turn it back over to Jason, I did get one question that was sent, Jason. I think it was sent just to me though, so I'm going to go ahead and ask it. The question is really toward Paul. And the question is that, is there a concern that once all of the pauses on foreclosures ends, is that going to cause a spike in available housing as people are foreclosed on? And does that have the threat of driving home prices back down?
Oh, that's a great question, because actually, when I was talking to when I had my house refinanced just recently, the inspector came and looked at it, and we had a discussion about that, and there is probably some supply issues that's driving up prices now, and you might see that reset as people start to move around more. So on the foreclosure side, um, I don't know what's going to happen with that, but there is a tremendous amount of overhang. So, I mean, I can't say that I know exactly what's going to happen, but I do think that there will probably be some downward pressure on homes when things start to move around, and supply starts to come back. I mean, it's a supply and demand issue. Will they fall below where they are, or will they just start growing slower? That'd be the question that I couldn't answer.
Thanks, Paul. I guess I'll piggyback on that. I don't see any questions in the group chat just yet. So I'm going to ask a question to Todd. And Todd, what are you seeing in terms of defaults on commercial loans related to the pandemic?
You know, I will tell you, so far, knock on wood, very, very low. We had another tremendous year. Now, I think the final shakeout of this is yet to be seen. And I'm not trying to be a naysayer, but, you know, there's always that lag. There are some companies and some businesses that quite frankly aren't going to make it, and that's very unfortunate. And I'm just speaking for Mercantile. I can't speak for the other, industry colleagues on the phone and what they're seeing. But overall, the stats that I gave you were for community banks in all of Michigan. So, the non-performing assets continues to remain very low. I don't anticipate anything close to what we had back in the Great Recession. I mean, this will hopefully be a spike, and we'll see a lot of businesses come back. Maybe even the restaurant and smaller business will come back in a different form. But we just haven't seen it yet. We haven't felt it yet. Now, again, we were able to do 90 and up to 6-month deferrals, both on principal and interest, which then they pass along to their tenants and so forth on the real estate side. So, that's where we just haven't, all this has not flushed through the system yet. I'm hoping that it does not turn for the worse, but we haven't seen it yet, Jason. So.
Well, thank you. I am getting some comments and questions in the group chat, and I'll start with the first one. And either Paul or Todd, I'll leave it to whoever wants to comment on it. But what effect do you think the change in the presidency will have on the economy? What industries might benefit and what industries might be adversely affected by that change?
That feels more like a Paul question.
Well, if I knew that, I wouldn't be working today. But it's thank you so much. Yeah, I think one of the things that's going to happen with the new administration, although you may not agree with the politics, will be less uncertainty. I think that'll be very positive. I don't know if you saw the stock market yesterday, but it exploded. It's of course, it's a lot of that's being helped by what the Fed is doing on creating financial access to capital, and people are borrowing money at a low rate and putting it in the market. But and then those people looking for return. But I actually think it's going to help some industries and help technology, even the auto industry. There's been this big move towards electrifying the auto fleet, and that's going to happen. The current administration has tried to do all it could to eliminate some of the fuel efficiency, those types of things. But the major auto producers are making electric cars. Are going to go there. That's going to happen. It's in their plans. So that I think helps spur that transition more quickly. because it's going to need investment in infrastructure. You're going to need charging and more ability access to electrification, and that's going to be positive. So I think overall, it's probably not going to be that much different. There'll be a lot of complaints, but my personal opinion is the uncertainty. I've never talked to a business leader that loves chaos as much as the current administration loves. I mean, I've sat in a lot of roundtables with business leaders. The trade negotiations were a disaster. If you look at I didn't show the federal deficit, but it was over $1 trillion in one quarter annualized last quarter. So the uncertainty, just eliminating that, and business people don't mind, as long as they know it, and use inflation for an example. If we can live at 4% inflation, as long as you know it's going to be 4% inflation, and you can put that into your budget and you can plan for it. 2% we say is kind of the number that's always worked, but is it arbitrary? Yeah, it could be anything as long as it's consistent. And so eliminating the volatility is going to be the biggest thing, I think, that's going to help business leaders and help the economy moving forward.
Yeah, I would just add a couple of things there. If you look on a personal level, I think the savings rate was at an all-time high. A lot of that having to do with the stimulus and the money that was sent out, but there's a lot of money sitting in savings and checking accounts from an individual standpoint. And then if you look at the PPP loans, we had lines pay down, so our lines of credit are at an all-time low from a utilization standpoint. Our deposits are way up. So companies, again, not everyone. There's a lot of companies that are sitting on quite a bit of cash as well that will now have that to potentially do acquisitions, expansion, what have you. So I think some of those things are positive, and I could not agree more, Paul, whatever side of the aisle folks are on, having a stable, all right, here's where we're focused, here's where we're headed. I think that gives business leaders, the chance to really plan ahead. So just wanted to add that. Thanks.
Yeah, thank you. And Paul, you mentioned briefly the stock market explosion yesterday. We have a question for you to comment on the stock market, I guess, generally, but maybe any additional thoughts on what you are thinking in terms of future stock market movement?
Well, I have one stock tip, and that's buy low, sell high. I think the market is doing quite well because there's so much liquidity out there. I mean, it was pointed out by Todd. I mean, we've hearing from business leaders they're sitting on tremendous amounts of cash, and households are. My expenses are down. I mean, this pandemic, I'm making my same pay and I'm not going anywhere. So I think that's helping the stock market going forward. The market is pretty good at picking the winners and losers. I'm not. If I try to do that, I won't do well. So I think the market is poised now for what it's expecting for the future. I mean, if you look at the way the market is supposed to be priced, I do know the PE ratios are quite high. So there is probably a tremendous amount of speculation in that now, as interest rates on bonds and stuff are so low, and you might as well put your money in something that you're going to get a return. And there'll probably be some correction in that. But for the most part, I think the market is set for the recovery, and once that starts, you may see some corrections. But stock traders are really good at picking and planning for the future. So this is supposed to be the present day value of future earnings. That's what should be in there. Now there may be some inflation because of speculation, but I think overall, the market does a really good job of doing that. So I always just indexed funds, those types of things, they seem to know what they're doing, and I think that's a great way. You're going to need, if you want to see another big crash in the market, it's going to have to be another great recession or another big downturn that's going to cause a big issue. But right now, I think the market's poised for a strong recovery. Everybody's just sitting and chomping at the bit. We came into this recession. It wasn't a structural change. It was a malady. And everybody's ready to get back to work and go. And I think once that happens, people are going to hit the ground with both feet pumping, and that market's going to is already reflecting that.
Fantastic. Um, with so many restaurants and small businesses going out of business and the probable reduced need in office space due to the advent of people working at home, um, I guess I'll leave this to either one of you or both of you. How do you feel this? How do you feel this will affect the commercial real estate industry? And what do you see over the next 12 to 24 months as companies reevaluate their physical space needs? Maybe I'll start with you, Todd.
Yeah, a couple things there. As far as the physical office space, I think everyone's going to evaluate that. As mentioned, I think a lot of office space had gone to, more of that open floor plan where you just come in and pick a spot and do this. I think, if you go back to having offices and starting to separate people a little bit more, you're probably going to need about the same square footage. But again, it might not be as many people in the office on a day-to-day basis. There's a lot of companies, I think we're all starved for human interaction, quite frankly. And I think a lot of these industries, a lot of businesses, I think we will come back to the office, maybe not at the same level as we have. I'm not answering the question there because it's a really hard question to answer because I just don't know. And each industry is going to look at it differently. As far as restaurants, I can tell you, speaking from personal, experience, I'm used to going out 3 nights a week and having dinner and we're empty nesters and so forth. I think people were starved, no pun intended, to get back out as well. And I think once we do recover, I think restaurants, whether maybe you did go out of business and you can get back into business with some help, I think restaurants will bounce back. I think people want to go out. We're the type of folks that do want to go out and do things. We have disposable income. I think it will bounce back. Now that might take a couple of years before we get back to that, but I just think I think we will look back on this and it will change how we live. It'll change how we act. It'll change how we work, but we'll get back to some sort of what we were used to. And that is getting out and seeing people and going out to lunches and meeting face to face. I'm probably aging myself by that, but I certainly miss that. I do not enjoy working from home or remotely and not seeing people face to face. So Paul, please jump in, or anybody else. That was a lot.
I would agree that there's a tremendous amount of pent-up demand in the service area, which could be inflationary as we come out of this pandemic. I agree that restaurants. I think one of the things the pandemic has shown us is how much we take for granted our workforce and certain kinds of amenities that are available to us. Such as restaurants and entertainment, those types of things, and we need to. I think we're going to be rethinking that as we move forward. At least I hope we do. But I do think that the tremendous amount of pent-up demand, especially in entertainment, travel, in the areas of restaurants. It's a shame these restaurants have to go out of business, but the spot is still there, the location's still viable, the people are still driving by the building. Someone will repurpose that, and it'll be functioning again real quick because of the amount of pent-up demand. As for office space, I tend to agree with Todd. There's a lot of discussion about more space, giving people room to be. This pandemic is going to leave an indelible mark on people on how they interact with people. It's going to be a long time before people are going to be comfortable to go out and sit next to somebody within 3 feet and feel comfortable. That could be another 2 years out down the road. So I think there's going to be a lot of repurposing of that space, and businesses we're so resilient. We find ways to make that stuff work. So I think there'll be a period of lull, but I think once we start to redefine ourselves, that space will be used, and restaurants will open. And I would say now, when do you think the pandemic's gonna end? Go out and make a reservation at your favorite restaurant right now, because you're not going to get in the door if you wait.
Well, thank you. I guess off of that, Paul, any idea how long you think it'll take before we can accurately assess the impact this pandemic has had on the national economy?
Well, we're assessing it daily. I think what the impact's going to be is how does it change? Does it change how people react? And I don't know. I think most people want to get back to the way they remember things being. You also got to remember one of the issues that's taking place is uh, we were right at the changeover from the baby boomers to the millennials when this started. If you're looking now, you're seeing a lot of boomers retiring now. Their portfolio looks great. They got money in the bank. Why risk it? I'm 65, 68, 67 years old. I'm going to retire. And there's been a lot of research done on how millennials are kind of resenting the boomers. When are you going to leave? When are you going to open the door for my opportunity? And this pandemic seemed to come right at the cusp of that. So I think um, um, we're going to see that transition from one generation to another. And I'm not a millennial, so I don't know how they're what they want, what they like, what they don't like. But that's going to be the challenge of businesses to go out and make sure they offer the services and the goods that the overall demographic desires. And so I'm thinking like a millennial right now. I just want to get to a restaurant. I just want to open a bottle of wine. I want to be able to have a nice thick steak, and then let my doctor worry about my cholesterol.
We have another question, I should say, in the group chat, and that is, how do we pay for the state and federal costs associated with the recovery, and how will that impact our economy?
Taxes. One of the big issues is one of the concerns that I've seen mentioned is what's going to happen as state and local governments try to generate revenue. You think it's a surprise that we've legalized marijuana? Do you think it's a surprise that we've legalized online gambling? I mean, these are different ways of generating revenue. And so there's going to be a lot of issues on how we're going to generate the revenue we need. And I think society in general, and of course, this is my personal opinion, not to necessarily represent the view of the Fed. As a society, we have to decide what we think is needed. I mean, do we need healthcare? Yes, I think everybody in America needs. We're the richest country in the world, and people don't have homes and don't have healthcare and can't get food. So I think a lot of that the pandemic is forcing people to kind of reprioritize some of these issues. Do I mind paying taxes? Yeah, I mean, I don't like seeing my money go out the door, but if I'm getting something for it, and this may be one of the positives of the new administration, if we see infrastructure spending, if we see opportunities that are created from this, new types of jobs and new technology, new types of energy technology, those types of things, I think people will start to see the benefit of paying for that. And again, it really kind of points to the fact that you can't run a government like a business. You just either who wants to buy a bridge, who wants to buy a road. Businesses are going to make that decision based on return on investment. And so I think we have to really kind of start thinking about what's needed, and investing more in human capital as well as physical capital. We just don't invest enough money in human capital. And I think if we did that for a long enough period of time, because there's going to be a delay in seeing the return on that. But once people start to see the return on investing in education or investing in infrastructure, then they'll be more willing to go along with it and maybe chip in the extra dollar necessary to make that happen.
Thank you. Not seeing any other additional questions in the chat. Maybe I'll ask one final question unless we see somebody else pop into the chat room. But any thoughts on the greatest threat to the economy over the next 12 months, either of you?
Well, over the next 12 months, it's still the virus. It really is. I mean, everything's virus right now. Then after that, I would look at state and local funding. What's going to happen in a lot of municipalities and those types of those areas that are, because states aren't allowed to run a deficit. I mean, they can't do what the federal government can do. And so I think we need to start to recognize that we walk down this aisle hand in hand, and there's a role for both federal and state government, and how are some of these small municipalities going to make up for this? And if you start cutting funding for education, college funding, look at higher universities. Universities are really struggling. Not only is there a declining demographic, fewer children, but there's an overload of capacity, and we're seeing it in the auto industry. Look what just happened to Fiat Chrysler. So there's going to be a lot of consolidation. We're going to have to start to see that take place, and that people may see as a threat, but I think those types of things will have to take place, and so I would point to the virus and how state and local governments come out of this as being two of the biggest challenges as we come out of this pandemic.
Well, thank you. I think, Joe, that's all the questions we see. I know this is being recorded. We do have a question for a copy of Paul's presentation. I'm assuming the chamber is going to post this somehow. Maybe you can answer that question.
Thank you, Jason. Yes, we will make this available in our webinar resource section of our website, where all of our webinars, I guess since March, have resided. I do want to mention before I wrap up here that I think Todd actually alluded to it. So the chamber yesterday afternoon, we did send out what we thought was a fairly comprehensive summary of the latest CARES Act legislation. There's a lot of great information in it. So it should be in your inbox. It may be in your clutter box. Hopefully it's not in your junk box. But if you're contemplating going for a PPP, if you haven't been eligible prior, or if you're going to look for a second round of funding, or if you're interested in diving back into the EIDL program as well, we've got a pretty good summary for you. And as always, we encourage you to speak to your lenders and your financial institution, many who are on this call that have really stepped up and taken the lead on, as Todd mentioned, on helping our members who maybe came to realize they didn't have as great of a relationship with their large national or multinational financial institution as they thought they did. And the community banks really filled a void there and stepped up. So please look for that information. Jason, thank you so much for moderating, and thanks to Clark Hill for being our lead sponsor for this morning's event. I want to thank Todd, obviously, and Paul. Paul, it's always a pleasure to get your insight, and we always try to book you early because I know that you're in hot demand on the speaker circuit. So we appreciate you making yourself available so early. I want to thank all of our sponsors again who helped us with this program. And in closing, I just want to mention that because of the situation with the pandemic, we're not anticipating having any live in-person programming or events for the first quarter of 2021. However, that doesn't mean that we're not providing great value and service and programming to our members. We have a robust calendar of webinars that we are planning for the first quarter. As soon as the weather breaks, we're hoping to maybe have move our member coffees back outside like we did in the fall, because we do know that people are craving, like Todd, that personal connection and to be able to do it. I apologize that we weren't able to serve you an amazing breakfast this morning at one of our member venues, but we look forward to the days that we can again. And lastly, we would just ask all of you, if you feel that you've got great value from your Chamber of Commerce, please talk about the Chamber with people in your professional circles who may not be members about the benefits of joining this wonderful organization and the wonderful businesses that comprise it. So again, I want to thank you all for attending this morning. It's great to see so many faces, and hopefully, fingers crossed, Vera, who, if you don't know Vera, is the managing director of Big Rock Chop House and the Reserve. So nobody has been impacted more great than Vera and her operation. So Vera, hopefully we'll get past September 15th. You'll be able to open at least on a limited basis indoors again, and we can all enjoy your amazing hospitality at Big Rock. So with that, I bid you all adieu and make it a great week and stay safe, mask up, and do what we need to do so we can get back to some sense of normalcy. Take care, everyone.
Thank you.